So this is chapter 4, second part. We're just going to finish up real quick. We've talked about the accounting cycle just in general terms, but let's go back through and just make sure we understand all the steps in the accounting cycle. So first thing is we want to understand, is there a business transaction? So that would be the first step. And again, we talked about exchange of value. We talked about performance of services or someone performing a service for us. That would result in a business transaction. It doesn't necessarily mean cash is changing hands, but this idea of exchange of value. So we could be accepting a promise to pay or providing a promise to pay. That would constitute a business transaction. Okay, then we would be looking at which accounts are being affected. And we did that as we started off even with our worksheet. Which accounts are being impacted? There has to be at least 2 accounts, but there can be more. Then we look to see, are those accounts going up or are they going down? And that was key because then that's going to help us determine how we apply the rule of debits and credits. And remember, an increase in an asset is a debit, and an increase in a liability or an equity account, or shareholders' equity, I should say, is a credit. And we also talked about the fact that we can make it easy in some senses because, first of all, common stock investments and revenues are always credits, and dividends and expenses are always going to be debits. So those are easy. The 4 components of shareholders' equity are always going to move one way. They're always going to be either debits or credits. So those are pretty easy. But assets and liabilities can move up or down. And that's where we're going to have to use the rule of debits and credits to determine whether cash, whether we debit or credit cash, whether we debit or credit accounts payable, etc. Once we've done made that determination, then we're going to prepare a journal entry. And I'm just going to use JE for journal entry. After a journal entry, then we're going to post that entry into our general ledger, and I'm just going to use GL. General ledger is basically where our accounts are. So general ledger is where our cash account would be, where our accounts receivable would be, where all of our supplies would be, accounts payable, dividends, etc. Once we post to the general ledger, we want to make sure the general ledger is in balance. So we'd have to do a trial balance. And because we haven't made any adjustments yet, this would be called our unadjusted trial balance. And again, I'm just abbreviating here so you can fill that in on your own. So unadjusted trial balance. Then what we're going to do is in chapter 3, so this is really kind of chapters 1 and 2. Then in chapter 3, we talked about adjustments. So of course we're going to do the analysis and get the information we need, and we're going to prepare an adjusting journal entry. And of course, anytime we have a journal entry, we're going to post that entry into our general ledger. Otherwise, it's not going to do any good to make the entry if it doesn't update the accounts. Then again, anytime we put anything into our general ledger, post anything, we want to make sure our general ledger is in balance. Otherwise, we're going to have a major problem. So what we're going to do is we're going to do an adjusted trial balance. Okay? So this is kind of chapter 3. So let me move this up a little bit so we can keep going. At this point in time, our accounts are all updated. They're adjusted. There's nothing more we're going to do to change the numbers at this point in time. So we can prepare our financial statements. Then after that, or simultaneous with that, really it's done almost at the same time in the computer systems, computerized accounting systems. The closing process is taking place. So again, here we would do our closing journal entries. Again, if we don't post those to the general ledger, they don't do any good. They have to update the accounts. So we post to the general ledger. And finally, wow, 14 steps. Finally, we prepare what's called a post-closing trial balance, because anytime we post anything into our general ledger, we want to make sure it's in balance. So we would do a post-closing trial balance to make sure that our general ledger is in balance, and then we're ready to start over. This could be each month we do this, each quarter, certainly each year, but most companies do this every month. So we're ready to start off the next month. Of course, most of this is done inside the computer, but and a lot of it's driven off of sales invoicing, purchasing invoicing, payroll accounting, things like that. So a lot of it feeds into the overall accounting system from other systems. But there still is someone who's, there could be a fixed asset system that calculates depreciation. That's fed in. Maybe automatically, but someone is still going to have to go through and make sure that there's certain journal entries that are made to reflect certain unique transactions, and someone is also going to have to go through and make sure that certain adjustments are made so that the financial statements are properly stated at the end of the period. So there are going to be certain manual interventions made in this process, but there are a lot of it is done by computer. Certainly the closing process is pretty much a mechanical process, so we're not going to spend a lot of time on it. You know, that really is a mechanical automated process, as is preparing these trial balances. Those are really automated processes that people are not doing by hand. Okay, so anyway, so that's the sequence of events. You should know that, understand kind of how that works, what comes before what, and that's pretty much the chapter. So fairly easy chapter, more mechanical in nature, but required to get the books ready for the following period, and also to update the retained earnings account and to complete the accounting cycle.